Welcome back. Let's talk business now. And Treasury bill investors have pumped in 181.4 billion shillings into 3-month Treasury bills in the last 10 weeks, handing the National Treasury a cash crunch headache when the debt comes due in the near term. Investors can either take out their money or roll it over into new securities when the debt comes due. When the maturities are large, investors usually demand a higher interest rate in order to do a rollover. Here's NTV's Brian George explaining that.
The Treasury bills auctions have been skewed towards the 91-day paper since mid-May, as investors avoid locking in their money for long periods as interest rates go up. By cutting their exposure to the minimum 3 months, investors retain the flexibility of reinvesting their funds at higher rates in case rates keep rising. Financial markets have been volatile since February, marked by shocks from the Iran war that has caused higher global inflation. In response, central banks have paused their monetary easing, while rates on government bonds and treasury bills have risen as investors seek higher compensation to cover against the erosion of real returns by inflation. In the Kenyan market, for instance, the last 10 treasury bills auctions have attracted 262.3 billion shillings in bids on the 91-day tenure against the government's target of 52 billion shillings. Out of these offers, the Central Bank of Kenya, CBK, has taken up 181.42 billion shillings, rejecting nearly a third of the bids on the paper in an effort to keep a lead on the rising interest rates. The 182-day Treasury bill has raised 59 billion shillings from investors' bids worth 63.9 billion shillings in the period, meaning that it has underperformed the government's target of 100 billion shillings. Similarly, the 364-day paper has underperformed in meeting its targets of 100 billion shillings, having raised 57.8 billion shillings against bids of 58.9 billion shillings.
I am sure you are very keen when data and figures were being presented by the Principal Secretary, National Treasury. You saw how much we are spending in various areas, especially expenditure heads, and more particularly on debt servicing and other CFS expenditures. And it is not a picture to be happy about. So we must look for ways of reversing this going forward.
This shows that momentum in the market has swung to the shortest of the 3 papers. The CBK prefers an even spread in volumes between the 3 tenures in order to maintain a steady maturity profile of the short-term debt throughout the fiscal year. Heavy concentration on one tenure means the Apex Bank will face a large volume of maturities bunched up in a short period of some point in the year, putting pressure on the exchequer if the market is unwilling to roll over the funds into the other Treasury bill tenures or longer-dated Treasury bonds. The Treasury faced such a crisis in March 2017 when investors were pumping in large volumes of cash into the 182-day Treasury bill. The CBK responded by suspending the issuance of the 6-month paper for 2 months to prevent refinancing problems down the road. This had the effect of pushing bids to the other 2 tenures, spreading future repayments.
Let it be clear that the government is not necessarily struggling to honor its debt, especially domestic debt, and in this case, the fixed income securities. As of last week alone, the government's share of domestic debt held in T-bills stood at 15.31%, which tallies to about 1.12 trillion shillings. Now, that is a massive improvement from what it held in 2019 June, which stood at about 34% of the share of domestic debt. Brian George, NTV, Nairobi.